Hello friends, now I am going to start new topic capital investment and capital allocation. It is part of corporate issuer. We have 4 learning outcomes in this topic, in this learning module. Number 1, describe types of capital investment. So I'm going to take various type of capital investment in this video, and then next onwards we will discuss the other second, third and fourth learning outcomes. Let's start with the capital investment. So let's understand first what is capital investment. So capital investment means business is investing in some asset. Businessman is investing in some asset. And when it is called as capital investment, it is expected that this asset, this where you are doing investment, is going to generate benefit or realize benefit for a period of 1 year or more. Then it is called as capital investment. So if you are investing in an asset where the intention is to realize benefit within 1 year period, these are called as short-term or current assets, and they are part of your working capital management. So here, capital investment, also called as capital projects, are investment with a life of 1 year or longer. So if it is having a life of less than 1 year, still it is asset, but short-term or current assets. So when you are investing for which is going to generate benefit for 1 year or more period, these are called capital investment. These can be plant machinery, land and building, furniture fixtures, motor vehicles, your trademark, copyrights. So here few assets may have physical substance, few may not have. Those assets which are having physical substance are called as tangible fixed assets or long-term assets. And those assets where the physical substance is not significant, then these assets are called as intangible assets, copyright and trademark. So now how these assets or these investment will be presented in books of accounts. These assets or these investments are presented as long-term assets in the books of accounts. So how they are recorded? Initially, let's say in year 1 beginning, you are investing in plant machinery 1 million rupees, $1 million, and it is going to have a useful life of, let's say, 5 years. So initially in the balance sheet at the year 1 beginning, these will be presented under the head assets as long-term assets, and this will be presented at a value equals to its cost. That is the total investment what we have done. But as the time progresses, as you move forward and you have realized benefit from these assets, so this 1 million should be systematically allocated while calculation of profit and loss every year. So let's assume this asset, this plant machinery, is going to generate equal benefit over its useful life of 5 years. So this 1 million should be split systematically equally over this 5-year period for charging against the profit, charging against the income to generate to find out your actual net profits. So that split, that systematic allocation is called as depreciation. In case of tangible asset, that systematic allocation is called as depreciation, and in case of intangible assets, that systematic allocation is called as amortization. Both are one and the same from numerical point of view, just the identification. Tangible systematic allocation is depreciation, for intangible systematic allocation is amortization. So in this case, that 1 million, if it is going, this asset is going to generate, assuming equal benefit over 5 years, then this cost will be split in 5 years as 200,000. Every year this 200,000 will be reduced from the cost of asset as in the name of depreciation, and will be transferred to income statement to find out the net profit. So if at the end of year 1 E&D, your balance sheet, this asset will be presented as plant and machinery, cost is equals to 1 million less depreciation 200,000, and this asset will be presented in the balance sheet as at the net at the net value. Next year, year 2, again when we are going to make balance sheet, 200 million will be reduced from the value of asset in the name of depreciation, and that depreciation will be charged as an expense in your income statement. How this asset will be presented in the balance sheet? Your plant machinery cost is equals to 1 million less accumulated depreciation. That is depreciation till last year plus current year, 400,000, 200 plus 200. So this will be presented at a value of 600,000 on the net basis in the balance sheet. So this way we are going to recognize and disclose the asset in the books of accounts. Now, what are the various categories of these capital investment? So in our study mat, they have classified these capital investment in 4 categories. Question may come to find out, to identify a particular situation as which class of capital investment. Example is, we were having manual accounting system in our business, and now we are going for computerization of the accounting process. So if we are going for computerization of the accounting processes from manual system, this is not going to generate additional revenue, but this is going to improvise the efficiency of doing the business. Or if you are having a manufacturing concern and now you are just replacing your old asset with the new machinery, then these are classified as going concern or the maintenance expenditure projects. The second category of classification of these investment is, you are running a educational institute, and because of fire safety norms, you have to install the complete fire extinguisher system, equipments and the complete system in your building, your educational building. Then just to fulfill certain fire safety norms or certain pollution, you are doing a manufacturing business, and because of some pollution control laws, you have to install certain pollution control equipments. So they are not going to increase the production or sales for the business. Generally, they are not going to increase the revenue for the business. So of course the expenditure is there, so it is going to generate a negative effect on the net profit. But without fulfilling these norms or regulation or law requirements, you cannot continue your business. So these category of investment, capital investment, comes under the second category, that is regulatory or compliance projects. The third category, where you are continuing in the same type of business. So you are expanding, and now you are expanding your production and sales work. You are increasing size or scale of your business, either by horizontally expanding or vertically expanding, by vertical integration or backward and forward integration with the business, different businesses. This type of capital investment is called as is classified under third category, that is expansion of existing business. The example is, let's say an infrastructure company is now getting into cement manufacturing business. So cement is one of the core raw material used by infrastructure company. So this type of business, this type of expansion come under this third classification. The fourth, where you are expanding into a new line of business, product, service, or a geography, which is altogether different from your existing business. Nothing to do with the existing business or the supply chain of the business. India's largest company, Reliance Industry, a O2C company, oil to chemical company, getting into a telecom business, Jio, or retail business, Reliance Retail. Jio, Reliance Retail, risk and reward profile is completely different from O2C business. This type of expansion comes under fourth classification, that is new line of business and other projects. And here the risk will be highest. The reason being, the O2C company is not actually aware about the risk and reward profile of that retail or telecom business. It may backfire for the company. They may fail or they may get success. In India, they are getting success. It's right now the success is visible. So what is the first classification? Going concern projects. These are actually maintenance or capital maintenance capital expenditure, just to maintain the efficiency or improvise the efficiency, but not going into the different business or expanding the size or scale of your business. They are just to improve efficiency, automation, replacing your old equipment with the new equipments. Generally having relative lower risk, lowest risk, because you are already aware about the risk and returns of reward of your existing business. And it is assumed, generally assumed, that whatever is your depreciation, because depreciation is the systematic allocation of your cost of original equipment. And why you are systematically allocating it? Because that asset is deteriorating by that value. So to improvise or to maintain the efficiency, you have to invest equal amount. So it is generally assumed that your depreciation and amortization cost is equal to your maintenance cost, maintenance capital investment. Regulatory or compliance project, they are to meet certain rules and standard. Generally do not add value, revenue. To example is pollution control laws or financial regulations if you are in a financial industry. Sometimes these projects create a barriers to entry for new entrant. Why? For, let's say, in a manufacturing situation, manufacturing industry, an existing player will be having capacity to do the expenditure on pollution control equipment for his plant machinery, for his factory premises. But for a new entrant, it is an additional cost where you are investing in some equipment which is not going to increase the production capacity. So for them, it is an additional capital requirement, which is also creating a barriers to entry, because for starting that new business, they will be required to bring additional capital for those equipments. So sometimes these investment create barriers to entry for new entrant and create competitive advantage or edge for the existing players. Expansion, we have already discussed that we are increasing the size of existing business, increasing the production capacity, or moving up or down on the supply chain. We are getting into our vendors business, or we are getting into the business of those users of our user businesses, those who are using our product for their business. Thread manufacturer getting cloth manufacturer getting into a thread manufacturing business. Increase, but of course the risk will increase more than your going concern investments, going concern projects. New line, riskiest, highest risk. Getting into new technology, new industry, new sector, new geography. Highest risk will be there because you are getting into unfamiliar business, and there is a risk of overpaying because you are not actually aware about the right correct value of that particular investment. It's a new for you. So these are the 4 classification. The questions will be where you will be required to identify or classify your business investment into these particular 4 classifications. So hopefully everyone understood it. Next, we will discuss capital allocation process and the various techniques of capital allocation process. Thank you so much.